G'day everyone and welcome back to another episode of the Aussie Dividend Machine. In this portfolio update, I wanted to cover the latest news, see how some of the top companies in the world are being affected, and then finally go over my own personal portfolio. The topics I'm going to cover are going to be the latest market correction. We're going to have a look at Tesla and the rise of General Motors. We're going to have a look at Australian journalists in China. We'll have a quick look at Credit Corp Group, and then we'll finish off with an update on my portfolio. As always, this video is for entertainment purposes only and does not constitute any kind of financial advice. Before making any investment decisions, make sure to go and see a fully licensed financial advisor. Don't forget to smash that like button and subscribe to the channel if you're enjoying the content. So, as I'm sure you would have heard, we're facing a market correction at the moment. We've seen the NADAQ in the US drop over 10% since the 2nd of September. This is a very fast drop off and one of the most rapid we've seen in history. This is likely because of an overvaluation of certain stocks on the market, particularly those in the technology sector. We've seen some big swings in stocks like Tesla, and then in the Australian market, stocks like Afterpay, Zip and Split. I think this can generally be attributed to an overvaluation because of the fact people thought that technology stocks were more resilient than others during the coronavirus pandemic. This led to an inflation in their value, and this was a little bit disproportionate to the actual intrinsic value of these stocks. Now, I'm not sure when this correction is going to end. I don't think anybody really does. However, for the moment, I'm definitely holding back with any stock purchases for the moment. So speaking of Tesla, let's take a quick look at that company. In the last few months, Tesla has been on a huge rally and their stock price has gone up to incredible levels. After turning 4 quarters of profit, everybody was expecting Tesla to make the S&P 500. The S&P 500 is a collection of 500 of the best companies in the US. There's certain criteria that a company needs to meet before they can be included in the S&P 500 catalog of companies. Some of the metrics that the S&P looks at is the market capitalization, how profitable the company is, and how long they've been profitable for. Everyone was expecting Tesla to make the cut this time, but in a shock announcement, they didn't. This led to a near 20% drop in the value of Tesla shares. Some other companies that have been profitable more consistently and over a longer duration made the cut ahead of Tesla. On the flip side of this, General Motors, which is another massive automotive maker in the US, share prices for General Motors actually went up. This is because they announced a new deal with Nikola. Nikola, similar to Tesla, is another EV manufacturer. However, they're yet to bring a fully fledged car to market. However, Nikola has been generating a lot of market interest. They specialize in trucks and pickup trucks in the EV space. They have products under development which are set to rival Tesla's own pickup truck, which proved immensely popular on its release. It's no surprise that with this partnership with GM, both companies have benefited massively in terms of their overall stock price. Now, GM could have been seen as a little bit behind in the EV game prior to this announcement, but this news has certainly injected a whole lot of interest in GM and really makes their future look quite exciting. I'll put up on screen a comparison between Tesla's share price and GM's share price over the last few weeks. As you can see, it's quite a stark difference. GM, unlike most companies on the exchange at the moment, has actually seen a price increase over the past few weeks. I think this is probably because their price to equity ratio is quite low, especially when you compare it to Tesla's. You're looking at a difference something like 30 for GM compared to over 800 for Tesla. A PE ratio of 800 for an automotive maker is just absolutely off the charts. It signifies that investors are thinking that Tesla is going to increase their earnings a huge amount going into the future. And I think it's starting to hit people that maybe this is not going to be possible, especially with other big automotive makers now getting into the EV market. I guess it really highlights how important it is to determine the real value of a company before investing, or at a very minimum, have a look at their potential future growth and try and understand if it's possible that they will actually achieve the growth that the price is saying they will. In the case of Tesla, I think with so much competition both in the US and internationally, I think they're a great company. I think they've got great products, but their growth forecasts are very high and it would be amazing if they achieve them, but I think realistically, maybe they won't. What do you think? I'd like to know your thoughts. Let me know in the comments below. So on to the next topic, and I wanted to talk a little bit about China because there's been some big news coming out of China recently.
China. You take China. China. I love them. China.
There's been some Australian journalists who have been detained in China. Now, the reason for these people being detained is that they were apparently a threat to the national security of China. This isn't the first time this has happened with foreign journalists, but it's definitely the most extreme example. As a result, the Australian government has issued a notice to all media companies saying, get your journalists out of China straight away because it's not safe. This is obviously a result of building tensions between Australia, China, and the US, and I've been covering this in the past few episodes on the channel. It's pretty clear to me that the relationship between Australia and China is not getting any better. I saw an interview on Sky News between a Sky News reporter and the Director of Defence in Australia, and it's really interesting to see what the Australian government's perspective on this situation is. I'll play the video now so you can have a look.
Michael Shoebridge, Director of Defence Strategy and National Security, the Australian Strategic Policy Institute. Michael, thank you for joining me again. Now, obviously, you can't say that you're surprised by China moving against our two last foreign correspondents in China, but how worried are you by it?
Andrew, great to talk to you. I think what we're seeing was unfortunately easy to predict, and we shouldn't think they will be the last journalists from the last countries. But we also shouldn't think they will be the last foreigners subject to arbitrary interrogation and detention by China.
US President Donald Trump overnight said, and it's not for the first time, he's pushing ahead with disengaging with China, being less dependent, being encouraging US companies to cut back on investments there, come back to America. Here he is again last night.
We're going to end our reliance on China because we can't rely on China. And I don't want them building a military like they're building right now, and they're using our money to build it.
It's easier said than done with us, with our huge exports, Michael, but should we do something similar?
I think in every area where China isn't structurally dependent on us, yes, we should. But where they're structurally dependent, and I'd count iron ore and energy as two areas where they are structurally dependent, they need us more than we need them. They cannot get what we sell them at the scale and at the prices and quality anywhere else. And they simply need it to keep their economy working.
As you can see, the Director of Defence highlights some of Australia's strong exports that we currently deliver to China, such as iron ore. He mentions that we should use this strategic advantage wisely. And he also notes the reliance that China has on Australia because of the iron ore that we provide to them. I think it's clear from this that the Australian government will not roll over to China's demands, considering that we have such a valuable commodity that we sell to them. However, when we have a look at the Australian website Smart Traveller, this is a website that gives information to the Australian public about travelling overseas. We can see that Smart Traveller is recommending strongly not to travel to China under any circumstances. I think this is really significant, especially for Australian businesses. How is an Australian business meant to conduct operations in China if they can't send any personnel over to that country safely? This is a big worry, and it's not an ideal situation for anybody involved. So from my perspective, unless you have a controlling commodity such as iron ore, doing business in China at the moment is an extreme risk. There's a chance that business people you might send to China from your company may not be able to return easily. I feel this is a big threat to companies that I've mentioned in the past who have a key part of their operations as an export business to China. Two companies with a key export business to China are A2 Milk and Bubs Australia. I really like both of these companies, and I think they've got a very solid business model and their track record is very good as well. However, the current risk facing these companies is huge because they base China as one of their main export markets. The current situation is a big risk for these companies at the moment, with a travel alert like we have posted and potential further escalation of tensions. It's a bad recipe for business. As I said, I like these companies. I think they're worthy of investment, but the current climate makes me very, very, very worried about putting my own money into these companies. Okay, so moving on, the next topic I wanted to talk about was the company Credit Corp Group. Now, Credit Corp Group is a debt collection agency. They've got some good fundamentals and a pretty good track record. They're also a company that has been flagged as a promising investment by some other YouTube channels, such as Compounding Everything. For the most part, I agree. I think they're a pretty good investment proposition, but in the last couple of weeks, we've seen their share price take a massive hit. I wanted to have a look at some of the reasons why this might be. Now, their business model operates by purchasing bad debt of companies that are no longer able to recover that debt. They specialize in recovering money that is owed. They pay a price for debt in the hope that they will be able to recover more money than what they paid for. This business model relies on being able to get a certain amount of money out of outstanding debt accounts. Obviously, the money that is recoverable depends on a lot of external factors. In general, in a time of economic hardship, there will be less money that is able to be recovered. So recently we've seen the coronavirus pandemic, which has put a lot of stress on people financially. On top of this, we've seen a second wave of the virus in the Australian state of Victoria, and this further increases the burden on people that owe debt. So it seems this is something Credit Corp Group has been able to predict and handle up until recently. Since that point, we've seen two big shifts. One, we've had the GDP numbers released for Australia to see how they fall historically. The numbers we got out of Australia's GDP movements were absolutely horrific. We haven't seen negative GDP growth like this since the Great Depression. That's factor number one. Now, factor number two is this recent market correction. Obviously, when the stock market goes down, people lose wealth. It's not surprising that the combination of these two factors has been a 1-2 punch to Credit Corp's share price. Now, this is just speculation on my behalf. We haven't seen any announcements come out of the company, but I think this overarching increasing burden that we've seen building up over the last year is now getting to the point where recovering debt is proving extremely difficult. We'll have to wait and see what the company releases in the coming days or weeks. However, I'm really interested to watch this one. I think potentially the downfall of Credit Corp Group could be an early indicator for a much broader market sell-off. Again, these are just my thoughts and opinions, but I'm really interested to see how this one develops as we go forward. Okay, so now let's take a quick look at my portfolio. If you watched the last portfolio update, you'd know that I sold off 2 shares within my portfolio last week. I went over the reasons behind these sales in the last episode, so make sure to go and watch that to see exactly why I sold the 2 companies that I did. Now this week, again, similar to last week, I haven't made a purchase. At the moment, I'm just stockpiling funds. The main reason for this is that there is a lot of negative pressure in the market. I've been looking at 3 key indicators to tell how the money is flowing in and out of the market. From last week, for the stocks that I was interested in, there was more selling than there was buying. This for me means that it's not quite the right time to enter a position in the companies that I'm interested in. Lo and behold, this week we've seen further selling and it has developed into a market correction. It's still not the right time to buy for me, so at the moment I'm just waiting and holding cash. As you probably know by now, the stock market is a long-term game. It pays off to be patient and wait for the right opportunity to come along, and that's exactly what I'm trying to do at the moment. When I do make my next purchase, I'll go through in detail exactly why I made the purchase and what indicators I was looking at for that particular stock that told me it was the right time to buy. So look out for that in episodes coming up. However, for now, that's all from me. Thanks very much for watching the video. Make sure to hit that like button and subscribe to the channel. Until next time, stay safe and cheers.